Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, June 24th, 2020. If you're long, it's not a pretty day out there. We're looking at pretty much all the major indices down over 1%. As a matter of fact, when I sat down, they were down. They took another leg lower. Pretty much coincided with ES futures breaking down through the lows that they saw last night on the Navarro China trade fake out, which were also the lows that we saw Friday afternoon. Post-close, S&P futures, actually all the futures, major futures, sold off sharply. And we've just broke through those levels, and now we took another leg down. I guess that was probably a very popular place for people to put in stops, and it looks like they just ran them. NASDAQ continues to be the relative outperformer. They're down, but not as much. Yesterday, I was on Bloomberg Television. I discussed something that I'd written about here on Friday, and we'll link to it at the bottom of the screen, about how over time the NASDAQ chart has really come to look like a parabola. It's been going up at a very fast linear pace on the shorter term, with, of course, the big hiccup that we saw in March and April. But for the most part, it's been a very fast linear pace. But when you step back and look at it over the longer term, it's a parabola. Parabolic charts don't tend to end well. Of course, parabolic charts, it's not clear when they end. And in some places, we still haven't really seen it. We've never really seen Tesla break out of its parabola, as the host noted yesterday on Bloomberg. But it's hard to imagine an index that is that heavily capitalized remaining able to grow at a parabolic rate. That has some scary implications, of course, because the longer-term moving average that we would be looking at, even if we're just to retest the longer-term moving average, that's around 8,500 level on NDX. Well, that's down about 20% from here. That would not be something that people want to deal with. That is, although it would be a normal reversion to the mean, and do not get me wrong, reversion to the mean strategies can often be a wonderful way to lose money because there's nothing that says things have to revert to the mean. But if we revert to that longer term mean, we're not talking about your garden variety correction. We're talking about bear market terminology. 20% is considered bear market terminology. So bear that in mind. I do not mean to be the doomsayer. I do not mean to be the gloomsayer. But you have to sort of reconcile, are you buying the stocks that are the major components of NDX? If you're long these things, are you long them because of a flight to safety? Are you long them because of their consistent track record in terms of revenues, if not earnings? Because in some cases, the track record of earnings is somewhat spotty. Amazon, for example. So how are you treating them? If you're treating them sort of as you would utilities, as a safe haven, you may want to reconsider that. They've become very, very crowded trades. The problem with very crowded trades that have gone up on a spike like a parabola, I can't call when that top is, but I can tell you when the top is put in, and you only know that in hindsight, really. It's not pretty because really then at that point there's nowhere to go. You talk about there is no alternative. At that point, from a stock market point of view, you kind of get to that. You kind of get to that sentiment, and the alternative becomes cash to a lot of people. So this is not meant to be a doom and gloom commentary. This is just meant to illustrate. And I've always wanted people to be aware of risks. One of the things I would say I've always been better at in my career has been playing defense than offense. I think I've been good at playing offense, but I think I've been much better at playing defense, spotting potential pitfalls. And this is the kind of thing that I would consider a potential pitfall right now, given the way the market has shaped itself up. So, again, not to belabor the point, but let's look at the news flow in these stocks, right? You were seeing, just sort of going through FANG, Facebook, we're seeing advertisers starting to boycott, although the flip side is many of them said, well, we'll come back if we really need to. Apple, we're seeing some more talk of antitrust investigation. I write my checks to Apple all the time, on a regular basis. They debit my credit card for using iCloud, among other things. And I'm very wedded to the Apple ecosystem. But is there anyone out there who's not looking for the 5G iPhone at some point in the future? how much mileage can you get out of that story? But right now, it's considered safe. They actually do pay a dividend too, so that's attractive. Amazon, said enough about that one already. Netflix, beneficiary of the stay-at-home trade. Again, their revenues are great. It's talk about mind share, but they still have cash drains, which are probably ebbing a bit because it's hard to produce new content in this environment. Google, again, you get the antitrust wins, but you also have the advertising. The fact that advertisers feel the need to be there. So you're looking at these stocks, which the positives are well known. I don't think the negatives have been priced in. And this is the sort of thing that worries me. Does it mean that you should be like running over and putting all your money in the mattress? No. Does this mean that you really should be assessing your risks? Just if you've had a fairly balanced portfolio, what you're going to find is that you're in some ways overweighted in the stocks that have won. That's normal. Now, we like to ride our winners, but make the decision why you're riding those winners. Are you just riding them because you're riding them? Are you riding them because you don't want to pay taxes on any gains? Or are you riding them because you really feel that there will be continued outperformance from these stocks? And I don't mean I shouldn't actually have said outperformance, not outperformance, because that implies relative performance. And unless you're an institutional investor, you don't really care about outperformance. You care about absolute performance. So unless you can see real absolute performance from these names, you may want to consider lightening up. I did read a story on CNBC.com today about the fear that pension funds may find themselves needing to do the same thing as they get into quarter end. I'm a little skeptical of that story, if only because pension funds, if they move their money into fixed income, they have no shot at meeting their mandate with interest rates here. So there's a lot of conflicting situations out there. There's a lot of maelstrom. Oh, and by the way, COVID is far from over in the U.S., which is the proximate cause for today's decline. I don't mean to be this much of a gloomy Gus. I really don't. But my goal is, at this point, not only return on capital, but return of capital. And I want anyone watching this to at least be aware of the risks that you might be facing in the markets right now. Have a good one, everybody. Bye-bye.